You may have recently seen headlines from Vanguard, BlackRock, or Morningstar that have predicted a dismal forecast for stock market returns over the next decade. Stock market returns will be muted over the next decade. Expect only 4 to 5% annual growth for the next 10 years. Prepare for a decade of disappointment. As a result, investors are getting nervous. They're asking questions like, should I take some chips off the table? Should I scale back my contributions? Should I find more productive alternative investments? Well, before you decide to abandon your stock market savings approach altogether, let's slow down, take a breath, and rewind the clock back to 2015. Back then, the same institutions that are making today's gloomy predictions were making eerily similar ones a decade ago. They said valuations are too high, the market's had a great run, it can't possibly continue, expect below average returns for the next 10 years. In fact, Vanguard forecasted 4 to 6% returns, BlackRock predicted 4.5 to 5.5% returns, and research affiliates predicted an anemic 1.5 to 2% returns. So what actually happened? Well, from 2015 through 2024, the S&P 500 posted a compound annual growth rate, or CAGR, of roughly 11.9%. That's not just solid, it's exceptional. Dave Ramsey had to have felt 100% vindicated. It was way higher than the 5 or 6% that so many stock market research institutions had predicted. In fact, not a single forecast from any of those financial institutions corresponded to the actual market performance over that 10-year time frame. But should we really be all that surprised? The answer is financial institutions making failed predictions about the future of the stock market isn't just the exception, it's the rule. The truth is you can do all the research you want, but the future is unknowable. Think about what happened between 2015 and 2024. We had a global pandemic that shut down entire economies. Interest rates fell to zero, then spiked in record time, massive government stimulus, a tech boom, a crypto craze, and the rise of artificial intelligence. Now ask yourself, how many of those events could have been predicted by any of those same financial institutions in 2015? The financial world is full of smart economists with PhDs who get paid to build sophisticated prediction models, but no one, absolutely no one, can see what's coming around the corner, which is perhaps why Warren Buffett so famously said, "Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future." So as you contemplate your investment strategy for the next 10 years, what should you take from all of this? Well, for starters, don't put too much stock in long-term market forecasts by large financial institutions. They have a really lousy track record of predicting how things will go. Those predictions might be interesting, and they might even be well researched, but at the end of the day, they're still guesses. Secondly, don't let fear drive your investment behavior. Just think, if you had listened to the predictions in 2015 and pulled your money out of the market, you would have been sitting on the sidelines during one of the greatest bull market runs of our lifetime. Don't make that mistake again. By the way, not only should you stay invested over the next 10 years, but you should be investing inside of tax-free accounts. Not only do you want to harness the power of stock market investing, you want to make sure those returns are taking place inside of accounts that are shielded from the impact of rising tax rates. I'm talking a balanced, comprehensive tax-free approach that takes advantage of every nook and cranny in the IRS tax code. I'm talking about Roth IRAs, Roth 401ks, and some properly structured cash value life insurance policies like indexed universal life. In summary, what drives long-term stock market returns? It isn't predictions, emotions, or headlines. It's innovation and productivity. And if you look around, you can see that those things are accelerating, not slowing down. AI is exploding the economy. Energy is becoming cheaper and cleaner. With the help of AI, biotech is revolutionizing the healthcare industry. Simply put, companies are becoming more productive and efficient. These are the types of things that don't show up on spreadsheets or 10-year stock market forecasts. So what should you do moving forward? Make sure you're harnessing the power of the stock market through low-cost index funds, rebalancing quarterly, focusing on time in the market, not time in the market, ignoring the headlines, and making sure you shield your retirement savings from the impact of higher taxes by investing in tax-free retirement accounts that help you take advantage of all the benefits in the U.S. tax code. Because if the next decade does end up delivering lower returns, you won't want to surrender any of those returns to federal taxation. If you'd like to develop a strategy that will help you wring the most efficiency from your retirement savings, head over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to a financial advisor in my Power of Zero network that has been trained, vetted, and qualified personally by me. And if you have any comments or questions, feel free to drop them into the comment section below. I'll do my very best to respond to all of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is Dave McKnight. Thanks for watching, and I'll see you on the next video.